The recent address by Nvidia CEO Jensen Huang at Davos transcended the expected discourse on semiconductor innovation, offering instead a profound and potentially unsettling warning that Wall Street and global leaders would be remiss to disregard. His pivot from discussions of computational prowess to the foundational elements of electricity, construction, and bond issuance marks a critical reorientation in how we perceive the artificial intelligence revolution. This was not a tech entrepreneur touting his latest chip, it was a visionary leader from the very epicenter of AI development sounding the alarm that the true costs and requirements of this transformation extend far beyond the silicon, demanding a radical rethinking of our global infrastructure, energy systems, and financial frameworks. Huang's warning fundamentally shifts the narrative of AI from a purely digital, software-driven phenomenon to a tangible, physical, and resource-intensive industrial revolution. The immediate implications of his specific mentions are staggering. First, the emphasis on electricity underscores the immense power demands of modern AI, particularly the training and inference of large language models and complex neural networks. Data centers, the physical embodiment of AI processing, are veritable energy hogs, consuming staggering amounts of power that challenge existing grid capacities and sustainability goals. As AI adoption accelerates, the global demand for electricity will skyrocket, necessitating not just incremental improvements but a monumental overhaul of energy generation, transmission, and distribution systems. This is not merely about powering individual servers but about ensuring a stable, abundant, and ideally clean energy supply capable of fueling an entire new digital economy. Without a corresponding surge in energy infrastructure, the promise of AI could be severely constrained by brownouts, blackouts, or simply unaffordable operational costs. The future of AI is, in essence, intertwined with the future of energy. Second, the mention of construction highlights the unprecedented physical build-out required to support this AI future. It is not enough to design powerful chips, those chips must reside in massive data centers, equipped with sophisticated cooling systems, redundant power supplies, and secure physical infrastructure. Building these facilities on a global scale demands vast amounts of land, materials, and skilled labor. The construction industry, often seen as a traditional sector, now finds itself at the forefront of enabling the most advanced technological frontier. This necessitates significant investment in planning, engineering, and execution, transforming landscapes and creating new industrial ecosystems dedicated to housing and maintaining AI infrastructure. The pace and scale of this construction challenge are immense, potentially leading to bottlenecks in materials, labor, and even regulatory approvals if not proactively addressed. Third, and perhaps most tellingly for the financial world, Huang's reference to bond issuance points to the colossal capital expenditure required for this multifaceted expansion. Developing new power plants, upgrading grids, constructing hyperscale data centers, and funding the ongoing research and development for next-generation AI will demand trillions of dollars in investment. This capital will likely be raised through various financial instruments, including corporate bonds, government bonds, and significant private equity injections. The sheer volume of this anticipated bond issuance suggests a profound reprioritization of global capital allocation, diverting funds towards infrastructure and energy projects that directly underpin the AI revolution. This has implications for interest rates, sovereign debt levels, and the overall liquidity and stability of financial markets. Wall Street, accustomed to valuing intangible assets and software multiples, is being alerted to the concrete, capital-intensive reality underpinning the AI dream. The financial plumbing of the world must adapt to fund a technological transformation that is more akin to building a global railway system or an entirely new electrical grid than simply launching a new software platform. To fully grasp the magnitude of Huang's warning, it is essential to consider the background and historical context of technological revolutions. Nvidia itself has undergone a remarkable transformation, evolving from a niche graphics card manufacturer to the undisputed leader in AI acceleration, effectively becoming the picks and shovels provider for the modern AI gold rush. Their ascent is inextricably linked to the exponential growth of deep learning and neural networks, which found their ideal processing units in Nvidia's GPUs. This history showcases the incredible speed at which new technologies can emerge and dominate. However, history also teaches us that every great technological leap, from the steam engine to the internet, has been underpinned by massive investments in foundational, often invisible, infrastructure. The railway age required not just locomotives but vast networks of tracks, bridges, and stations. The electrification of the world demanded power plants, transmission lines, and wiring in every home and factory. The internet required optical fiber networks, data centers, and sophisticated routing infrastructure. In each case, the physical world had to be re-engineered to support the new technological paradigm. What makes Huang's warning particularly salient is that the AI revolution is not merely building upon existing infrastructure, it is demanding an entirely new layer of physical capacity at an unprecedented scale and speed. Moore's law, while still relevant for silicon density, faces physical limits concerning power density and heat dissipation. The architectural innovations in chips alone cannot overcome a global shortage of electricity or the physical space to house millions of servers. This is where Huang's message converges with a deeper understanding of industrial history. Neglecting the foundational requirements will inevitably lead to bottlenecks, slowing or even stalling the very progress that the chips enable. The dog and pony show of chip specifications, while important, misses the larger, more critical picture of societal readiness for this transformation. The immediate context for Huang's warning is one of both immense opportunity and escalating global challenges. Economically, the world is grappling with inflation, rising interest rates, and geopolitical uncertainties. The massive capital allocation required for AI infrastructure could exacerbate inflationary pressures on materials and energy, while simultaneously driving demand in new sectors. Geopolitically, the race for AI supremacy is intensifying, making energy security and resilient supply chains for construction materials and skilled labor critical national interests. Environmentally, the carbon footprint of rapidly expanding data centers is a growing concern, putting immense pressure on developing green energy solutions and improving energy efficiency. Wall Street's traditional valuation models, often focused on software as a service multiples, recurring revenue, and intellectual property, may be overlooking the sheer industrial scale of the AI revolution. Huang is effectively telling the financial markets that they must broaden their analytical lens to include utilities, construction firms, raw material suppliers, and the bond market as central players in the AI narrative, not just peripheral enablers. The companies that own and operate power grids, that build megadata centers, and that can raise trillions in capital will be as crucial to the success of AI as the companies designing the algorithms and chips. Investors who continue to focus solely on the digital layer risk misjudging the true bottlenecks and the actual value drivers of the coming decade. The AI boom, in this view, is not just a tech boom, but an infrastructure and energy boom that will ripple across every sector of the global economy. In conclusion, Jensen Huang's unexpected declaration at Davos was a profound wake-up call, recalibrating our understanding of the artificial intelligence revolution. It signals a critical shift from celebrating algorithmic breakthroughs and chip advancements to confronting the immense, tangible, and capital-intensive demands that AI places on our global energy systems, physical infrastructure, and financial markets. His warning emphasizes that the future of AI hinges not just on technological ingenuity but on our collective ability to generate vast amounts of clean electricity, construct an unprecedented scale of data centers, and issue trillions in bonds to finance this colossal undertaking. This is an industrial revolution on par with the electrification of the world, demanding a fundamental re-engineering of our physical world and financial systems. Investors, policymakers, and industry leaders must internalize this broader perspective, moving beyond the fascination with silicon to strategically plan for the bedrock requirements of energy, infrastructure, and capital that will ultimately determine the pace and scale of AI's transformative power. The next decade of AI will be defined as much by our capacity to build and finance its physical world as by its algorithmic brilliance.